Reliance Mutual Fund and CNBC TV18 have lined up a mutual fund day this Friday to talk about the importance of investing in mutual funds and, of course, the road to financial prosperity. Varinder Bansal is in conversation with Sunil Singhania, CIO-Equity Investments at Reliance Mutual Fund. Varinder, over to you.
Well, Anuj and Lata, I'm absolutely privileged to have Sunil with me. Let me give you a small statistic. Till FY14, the total assets under management for mutual industry was 8 lakh crore. And in the last 3 years, we have added 10 lakh crore. So what journey we did till FY18 has been more than achieved in only in the last 3 years. Sunil, thank you so much for joining us. Are you amazed at the growth of assets under management and the retail participation we are seeing in the mutual fund industry?
Actually, obviously the last 1.5 years has surprised us positively on the intensity of growth. But in 2014 itself, we had actually come out with a public statement saying that we expect the mutual fund industry to hit 20 lakh crores by 2020. And in fact, last year we sort of upgraded the target to reach 20 lakh crores by FY18. So to that extent, we were expecting this. You always have a tipping point. Just to give you an anecdotal evidence, in the US, one of the largest asset management companies took 80 years to reach a size of $2 billion. And then from 2 billion to 2 trillion took them only 35 years.
That is capital, right?
Yes. So I think we always have a tipping point, and we believe that in India the tipping point started in 2014-15 and it's only going to accelerate going forward.
Well, the monthly SIP numbers are also very strong, right? From retail investors, 4,100 crores. And I think last, if I go back in 5 years, it was only 1,500 crores.
So 4-5 years back, the concept of SIP had started, but because the markets were very volatile, there was also this phenomena of investors sort of stopping their SIPs in between. I think investors are becoming more mature, more intelligent, and over the last few years, we have seen that in volatile times, in fact, the intensity of SIPs increasing has taken precedence. So we do expect that in the next 1 year to 18 months, this number of 4,000 crores will exceed $1 billion a month.
Wow, $1 billion a month. A lot of people invest via you. I think you are one of the longest serving fund managers, having an experience of 2 decades. Where does Sunil invest his money? Where do you invest? Do you invest in mutual funds?
So I have a reasonable exposure to equity and also some exposure to fixed income to have my near-term needs met because I have 2 kids, school-going kids. But I think very clearly the personal confidence in the Indian economy and the equity markets is very strong, and that is also reflected in our advice which we give to our investors that India is a country to invest. You have to invest in equity if you're looking at long-term wealth creation.
But one problem with some of the retail investors tell me how to choose a good equity fund, because whatever they see on money control is the past performance, and then the disclaimer comes, past performance is not indicative of the future returns. Of course, there are so many equity funds these days in the market. How to judge a good fund?
So I'll give an anecdotal sort of an example. In India, cricket and Bollywood are the 2 most followed things. Maybe the stock market after that. And if you actually see, Sachin Tendulkar and Virat Kohli will not hit a century every match, but they'll continue to be good batsmen. Or, Shah Rukh Khan, every movie will not be a hit, but he'll continue to be a good actor. I think mutual fund managers are also similar. You will not have the same fund manager being the best every year, but what you have to look at is the consistency and the long-term duration and the track record of that fund manager. So instead of hopping in and out of each fund based on a Morningstar rating or a money control rating or XYZ rating every quarter, I think we just have to look at 3, 4, 5 fund houses which have good fund managers and have confidence in the Indian economy and those fund managers to deliver returns. And frankly, whether you make 30% return or 32% return or 28% is not as important as whether you have 50% of your investment in equity or 5% in equity. If you have 5% in equity and you make 100%, and if you have 50% in equity, you make 30%, I think that the second option will be much better.
I honestly want to tell this, that in the last 20 years, there are funds like HDFC Equity, which have given you 95 times return. There is Reliance Growth Fund, which has given 90 times return. So there are many, many good funds, as you said, from diversified mutual fund industry, who has given 90, 95, 100 times return in the last 20 years. Let's talk about the markets a bit. Is it too good too soon?
See, markets will always have a habit of being slightly overweighted or slightly overvalued or undervalued from time to time. And I think the beauty is in the eyes of the beholder. So if someone who is optimistic about the Indian economy growing with maybe some speed breakers in between like me, I think any level is a good level to invest. You know, if you have a view that finally we are going to be a $4 trillion economy in the next 6-7 years. But if you're looking at 1 or 2 months or maybe 3 months, then maybe you would want to wait for some sort of correction, because you've already seen a 1,000-point rally as far as Nifty is concerned over the last 2 months. So
exactly.
It depends on the time horizon.
So on, you know, the IT and pharma, one space which you have mentioned earlier as well.
See, IT, our view has been consistent that the growth rates have slowed down, but at 14 times valuation, 13 times valuation, at a cash P multiple of like 10, 11 times, which is better in terms of earnings yield than even the GSEC bonds. And with a lot of negatives already been into the price, our view would be that it would be a decent sector. It would not give you phenomenal return, but it would give you decent mid-term returns. And obviously, you know, there is a lot of rhetoric going on right now with Trump views about H-1 visa and all. But we have also started to hear about the Indian government taking up the issue with the US government. So I think it's a decent sector to invest. India has world-class capabilities and cost advantages there. And even in pharma, we saw in 2015 a huge run-up. Maybe the stocks had become too overvalued. In 2016, it was exactly the opposite. I think a lot of these stocks are now reaching a good price from a 2 to 3 years perspective. And you know, a speech of Mr. Trump, the first speech after he took over as president, apart from his induction speech, clearly said that he's focusing on reasonable drug prices, and I think that is where the Indian pharma companies will come into place. So I think both the sectors are getting interesting. And in fact, IT sector last 1 month has been a good sector to invest in.
Phenomenal returns. Okay, you were very bullish on NBFCs, if I remember it correctly, and the private sector banks. Private sector banks have done phenomenally well, and now the smaller private sector banks are jumping since last many days. Is it only valuations or other things which are going into the market?
So I think it's a cycle. You know, if you look at NBFCs over the last 5 years, one NBFC has tripled every year. You know, that was a phenomenon. It was a new NBFC. So maybe there was some catching up being done by one, looking at the valuation of the other. I think right now our focus on NBFC space is still there, but we believe that gold finance companies have some way up to go still, because they are relatively very cheap compared to some of the microfinance companies. And at least from our perspective, we believe that the gold finance companies are secured microfinance companies. So, a secured microfinance company is available at less than 2 times book, and an unsecured microfinance company available at 4 times book. So we will go for the secured microfinance book. In terms of the old gen private sector banks, I think some of them have transformed gradually over the last 4-5 years, and we are seeing the results. A lot of them would transform as we move forward, because talent now is willing to join these banks and take them to the next level. So I think there is a lot of action in those banks. We are also sort of subtly trying to play the worst public sector bank theme. So it will be a small allocation for us, but we believe that the worst public sector bank might turn out to be the dark horse if bad bank and a lot of other announcements which the government is certainly making come true.
But do you think that the asset quality issues are behind now in public sector banks?
They are not worsening. How soon they recover will obviously depend on the economy. So steel sector, for example, is recovered. Some part of textile sector has recovered. Maybe the demonetization has deferred the realty and the construction sector's recovery a little bit towards the back end. But with again the focus being on growth, some of these sectors can definitely also start to turn around. So the worst is behind.
That's a contra call.
Now you need a little bit of luck and little bit of.
You also took a contra call in telecom, right?
Not to the extent which you would have liked, specifically in one of the largest companies. But yes, it's a sort of a market weight position.
Liquor hasn't played the way I think you were expecting, right?
I think investors are not drinking enough. But we continue to be quite optimistic. Again, the regulatory hurdles have been quite there. But with India's demographics, with 30%, almost 25 to 30% of every citizen in the world born after 1st January 2000 being an Indian, and they still have to come to the drinking age. Social drinking is now acceptable. Women are drinking. Even I'm a Marwari, and even in our weddings now we have cocktail parties. So I think that the consumption of responsible drinking is only going to increase. And I think this is one FMCG sector where the penetration levels are very low. So let's hope that they start to perform.
Of course, we all heard about Warren Buffett, what he said, and he made a very interesting point that index funds are the place to be, rather than going in for diversified funds. Is that same applies to Indian markets as well?
See, in India, if you again look at the history of the mutual fund industry put together, I think we have comfortably beaten the index, which clearly shows that there is a good alpha which is being generated by fund managers. I think it's a reflection of two things. Obviously, the fund management community overall is very efficient, but India is a developing economy, and there are a lot of new sectors which come up. For example, IT in 90s did not exist. And it's become now almost 10-12% of the index. Telecom did not exist till mid-90s. Then you have real estate, organized retailing, e-commerce, hospitality, pharma, which were very small sectors. Yes. And if you invest in say a Nifty fund or an index fund, you will not be able to invest in these upcoming sectors till they become really large. So I think as long as the country is growing fast, there is definitely scope of alpha generation, and therefore the actively managed funds are significantly outperforming the benchmark. For example, Reliance Growth Fund is 95 times in 21 years. The index in the same time is up only 10 times. So that kind of alpha has been generated over the last 21 years. And at least still the country continues to grow.
Very, very well.
Yeah. But we believe that you have to offer the investors both active and passive, and that is the reason why we are one of the largest players even in the ETF side.
That's so true. My last question will be, a lot of fear was there in the market when this demonetization happened, but the numbers, GDP numbers coming yesterday don't actually reflect that. You talk to a lot of people, whether it's corporates or investors. Do you think all these fears are now behind us in terms of numbers?
So, the attitude and the nature of an individual cannot be changed. So post-demonetization, there was deferment of demand. But if you are a young country, young population, and if you want to go out drinking, if you want to go out shopping, if you want to go out seeing a movie, you are not going to stop it just because instead of cash you now have to use your card. So I think we have adjusted, and over the last 15 years I have seen that Indians are resistant to change, but the moment change is thrust upon them, they are very fast in adapting the change. We saw screen-based trading, complete dematerialization of shares, maybe demonetization. So we are very adapt to change. So I think it's obviously a near-term sort of a roadblock, but eventually the country is becoming more efficient.
My last question is in the oil and gas space. A lot has happened and is happening in that space. How do you view that space as a fund manager?
So our view is that oil prices should be stable. So at least from a oil producers or explorers perspective, it is going to be a sort of a stable scenario. Our view is that refining margins may have sort of seen the best, and from here on they might not collapse, but might see some downturn. So I think the big outperformance which we saw specifically in the oil marketing companies might be behind us, and from here on at best they can be market performers.
Do you agree with that idea of the major merger between downstream, upstreams and all?
See, till the actual contours come out, it's very difficult to say. But only one thing I can say is that the sum of the parts theory in the Indian markets don't work. So we have seen a lot of holding companies trade at significant discount to the underlying because investors just don't want holding companies.
Lovely. And the last word from your side to all the retail investors, all the big investors who will be watching you and all on 3rd of March?
So I think from a retail investor's perspective, India is growing. We have reached $2 trillion in the last 67 years. We are very confident that from 2 trillion will be 4 trillion in the next 6-7 years. Please, please, please be a part of this growth, benefit from this growth. It is very painful to see foreign investors make so much money and Indian investors sitting in India shunning away from equity. So start the SIPs, start investing. March 7th is Mutual Fund Day, don't forget.
Well, thank you, Sunil. It was wonderful as always.
Thank you.
Back to you guys.